Target earnings coming up, and you can see over the last 5 years, this stock's gone from 250 down here to 100. We're going to go through why we don't think it's cheap enough here at $100, what we think we'll see in earnings, and why we are not a buyer down here yet. So why has Target stock gone down? Take a look at this revenue growth number right here, and you can see negative 3%. So they are losing revenue. The stock market absolutely hates negative revenue growth. But on top of that, another thing is happening. Net income percentage at 4%, which is very, very low. They sell a lot of goods and don't make a lot of money, has gone from 4% to 3% expected. I know that's only 1% in absolute, but in a relative amount, it is a large jump lower from 4% to 3%. So despite those negative pieces, we do like buying stocks when they get really, really cheap. Is Target really, really cheap? Let's take a look at it. It is 8 times EBITDA. That's pretty cheap compared to the stock market. But if you look at price to net income, it is 18 times net income. That is actually fairly high or moderate for the stock market. PE, again, in the very cheap zone of 13x, but free cash flow yield at 4.4%. Not as attractive. So two of those valuation metrics make it look cheap. That's PE and EV to EBITDA, but net income and free cash flow are just okay. So this stock is not incredibly cheap, just sort of cheap. If you've been watching our videos and want to invest alongside us,
click the link in the comments, select your brokerage,
search for ticker RVER wherever you buy stocks.
Thank you, and now back to our video.
So let's take a look at the quarterly numbers and let's show you what happened last quarter to scare the heck out of this stock. See the net income margin that was running about 4% that we talked about earlier? It went down to 2%. And what happens when it gets that low? Look at free cash flow. It actually gets negative down here, meaning that they are not making money at 2% margins. Let's take a look at what's supposed to happen this quarter to try to call the quarter's move. Revenue growth is actually supposed to get worse from 3% negative comp to a 4% negative comp. But the market is expecting this 2% net income margin to hop back to 4%. That is a very high bar it has to jump, especially since tariffs have been implemented in this quarter. And so they would have to raise a lot of price with negative traffic and negative revenue growth to jump back into that 4% margin. We think that bar is a little too high to jump over and would only buy this stock if it's very cheap, which was, as we said before, it's not very cheap, it's just kind of cheap. So we love cheap stocks and low bars to jump over. We think this quarter in Target, it isn't cheap enough and the bar isn't low enough. We are still not in here at these prices in Target. Thanks for watching, we really appreciate it. Hit those likes and subscribe buttons, and if there's anything you guys want to see, please let us know.